Financial archaeologists scanning global monetary flows have detected an anomaly that violates basic mathematical principles. The world economy operates on $307 trillion of debt that never existed when borrowed. Every dollar in your account was created through debt. Every mortgage, credit card payment, government bond, conjured from nothing through fractional reserve banking. But its true function is planetary wealth extraction. Case File 127, The Infinity Machine. How a mathematical impossibility became civilization's foundation, and why your money loses value by design. The process begins with a keystroke. When banks approve loans, they don't transfer existing money. They create new digits instantly, backed by nothing except promises to repay with interest. This newly created money enters circulation, but the interest required was never created. If banks create $100 billion in loans requiring $105 billion repayment, where does the extra $5 billion come from? Fractional reserve multipliers amplify this exponentially. Banks hold only 10% of deposits as reserves. Every $100 deposited generates $900 in new loans. Money multiplies through debt mathematics. Central banks orchestrate this through interest rate manipulation. When rates drop, money creation accelerates. When rates rise, supply contracts. They call it monetary policy. It's actually demand engineering for debt products. The Federal Reserve, established 1913, is not government. It's a private consortium granted monopoly over money creation. Every dollar comes with interest attached, paid by taxpayers to private banks. Government borrowing amplifies extraction. When governments issue bonds, central banks purchase them with newly created money. Public assumes debt, private banks collect interest on money created from nothing. National debt becomes mathematically unpayable by design. U.S. debt exceeds $33 trillion. Interest payments alone consume 15% of federal budget, flowing directly to bondholders who created original debt through keystrokes. Inflation is not market force, it's system feature. New money entering circulation decreases existing money's purchasing power proportionally. This hidden tax transfers wealth from savers to debtors, workers to asset holders. Money velocity determines inflationary impact. New money flowing into assets, real estate, stocks, commodities, inflates prices rapidly. When flowing into wages, inflation appears delayed. Central banks manipulate these flows deliberately. Quantitative easing revealed the system's nature. Central banks created trillions to purchase toxic assets from failing banks. This money didn't reach consumers. It inflated asset prices, enriching property owners while devaluing currency. Debt and growth create perpetual expansion pressure. Since money exists through loans, economic growth requires constant debt increase. Debt reduction triggers recession by shrinking money supply. Infinite borrowing on finite planet. Corporate debt dominates money creation. Business loans generate more new money than consumer borrowing, but corporations use capital to purchase assets and automate labor. Workers compete while financing their replacement. Wealth inequality accelerates through monetary mechanics. Those closest to money creation benefit from new purchasing power before prices adjust. By the time wages increase, inflation has transferred wealth upward. Housing markets demonstrate extraction efficiency. Mortgage lending creates money flowing directly into real estate, inflating values beyond wage growth. Homeowners benefit from appreciation. Renters face perpetually increasing costs, funded by labor. Student debt exemplifies predatory nature. Universities raise tuition knowing students can borrow unlimited newly created money. Graduates enter workforce already indebted to banks for money that didn't exist when borrowed. Retirement systems become wealth transfer mechanisms. 401k plans purchase government bonds and corporate debt, essentially lending workers' retirement savings back to institutions that extracted their wealth throughout careers. International policy extends extraction globally. Dollar reserve currency status allows America to export inflation worldwide. Other nations accept appreciating dollars for real goods and services, technological tribute system. Cryptocurrency emerged as alternative, but central banks developed digital currencies maintaining control. Central bank digital currencies eliminate physical cash entirely, making every transaction trackable and controllable by authorities. Mathematical impossibility creates systemic instability. As debt compounds exponentially while productive capacity grows linearly, system requires periodic debt destruction through financial crises, transferring assets at predetermined intervals. Economic education deliberately obscures monetary mechanics. Universities teach supply and demand theory while ignoring money creation through debt. Knowledge gap prevents public understanding of wealth extraction operating plainly. Political campaigns receive funding from monetary expansion beneficiaries. Banks, real estate interests, government contractors support candidates maintaining current system. Electoral democracy becomes selection mechanism for monetary policy preferences. Social problems intensify as wealth concentrates. Homelessness, healthcare costs, education expenses. Retirement insecurity stem from currency devaluation and asset price inflation. System creates problems politicians promise solving through more debt. The infinity machine operates through mathematical deception. Money appears limitless through keystrokes, but purchasing power remains finite. Every dollar created dilutes existing money value, transferring wealth from holders to creators. This system is not accidental, designed by banking interests in early 20th century. Complexity is intentional, preventing public comprehension of wealth extraction mechanisms. Economic policy is actually organized theft through monetary manipulation. Alternative systems exist, but face systematic suppression. Local currencies, precious metals, decentralized technologies threaten extraction mechanisms. Regulatory capture ensures monetary alternatives remain marginalized or co-opted by existing institutions. Environmental impact multiplies through enforced growth requirements. Money exists only through debt creation, demanding infinite expansion on finite planet. Climate change, resource depletion, ecological collapse result from monetary mechanics requiring consumption growth. Individual resistance includes asset ownership, debt minimization, alternative value storage, but systemic change requires public understanding of monetary creation mechanisms. First step, recognizing money isn't scarce. Purchasing power is artificially restricted. Case file 127 concludes, economy is not natural system governed by market forces. It's wealth extraction mechanism designed concentrating purchasing power among those controlling money creation. Understanding transforms statistics from phenomena to engineered outcomes. The infinity machine continues operating through public ignorance of mechanisms. Every loan approval, government bond sale, interest payment feeds wealth upward through monetary system. Machine runs on debt, debt runs on impossibility. Mathematical deception creates systematic wealth transfer from productive workers to financial institutions through currency debasement and debt multiplication. The greatest theft in human history operates through public education systems that deliberately obscure monetary reality. End of economic analysis. Archives sealed. Remember, in a system where money is created through debt, those who create money will always extract wealth from those who earn it through labor. The truth is always hidden in plain sight. Every economic statistic, every financial crisis, every policy decision serves the same function: concentrating wealth among those who control the creation of money itself.